When it comes to achieving financial freedom through passive income, there's a lot of different routes you can take, many of which I'll cover on this blog. However, in my opinion, living off of dividends is one of the best. Dividend investing can be one of the easiest ways to earn passive income. You can receive regular payments directly to your brokerage or bank account without putting in all that much effort. Pretty much checking your portfolio every few months is all that's required. Even if you can't fully rely on dividends for a living, that extra income could make a significant difference. This extra income could help you switch to a job you enjoy, work part-time, or spend more time on loved ones. So if you're looking to build a reliable passive income stream, dividend investing is an excellent option to consider. Dividend investing requires minimal effort, especially if you go the ETF route, and provides a consistent source of income that can help you achieve financial freedom. Now, for me personally, the bulk of my retirement savings are in VO, which is the Vanguard S&P 500 fund, and this is because I'm seeking growth over income at this particular period of my life. However, in my non-retirement accounts, I do personally own a decent chunk of shares in these high-yielding ETFs I'll cover in the second half of this video, all of which I'm reinvesting back into more shares. So, getting back on topic, living off of dividends can feel like a dream for many because it often seems out of reach due to the high amount of money required to make it a reality. A quick search on various financial websites will say that you need a couple $1 million or more saved up for retirement and live off dividends at minimum. Most of them say $1 million. However, this can be a discouraging reality for many people who don't have that kind of money to invest. The good news is that there is a way to achieve this goal without needing to invest millions of dollars or waiting decades until retirement. By carefully selecting dividend-paying stocks or dividend ETFs and reinvesting your dividends, you can steadily build your portfolio over time and generate a reliable income stream. Of course, this approach requires patience and discipline, but it's a viable option for those who are willing to put in the time and the effort. By focusing on quality stocks with solid fundamentals and a history of dividend growth, you can create a diversified portfolio that provides a steady stream of income without the need for a massive initial investment. For this example, I'll assume a monthly income of $5,000, which may or may not be adequate depending on your individual circumstances. If you have 4 children and you live in San Francisco, your financial needs will be much higher than someone living frugally in Royal George. Now let's analyze some popular dividend growth investments, which are often featured in financial articles and videos discussing how to retire off dividends. My first example will focus on Pepsi, which goes by the ticker symbol PEP, which is one of the more widely recognized dividend stocks. According to Yahoo Finance, and at the time of this video recording, Pepsi shares traded for $172.86 and currently yields 2.68% with a quarterly dividend of approximately $1.16 per share or $4.63 per year. To earn $5,000 per month or $15,000 per quarter, we need to purchase 12,951 Pepsi shares, which equates to $2,238,710 in investment capital. Essentially, all I'm doing is taking the yearly income needed and dividing that by the yield of 2.68%. However, it is unlikely that most people have this amount of money to invest, let alone accumulate that in a lifetime. Although dividend investing can be a sound strategy, the downside is it can take a significant amount of time to build wealth, and oftentimes the majority of one's working life. Investing in low-yielding stocks like Pepsi means waiting a long time for significant returns. Now, when this happens, many people lose motivation and give up due to the long and arduous process. So, it's important to consider alternative investment options, such as higher-yielding stocks. Let's explore another highly popular stock, Verizon, with the ticker symbol VZ. This company, as most of you know, provides telecommunication and cell phone services. Currently, Verizon yields 6.81%, which is higher than most consumer staple stocks, and as of the time of this video, Verizon pays $2.61 per share per year. To earn $15,000 per quarter or $5,000 per month with Verizon, one would need to invest $881,057 and to approximately 22,944 shares of Verizon, given its current share price of $38.40. While this is still a significant amount of money, it's not nearly as high as Pepsi's roughly $2.2 million. However, this is still somewhat unattainable for many people to accumulate such wealth that quickly, even with monthly dividends that allow for faster compounding, it'll take most people a long time to hold enough shares of Verizon to live off. Therefore, let's explore a different stock with an even higher dividend yield to up the ante. Another stock you may not have heard of before is EPR Properties, with the ticker symbol EPR. This company is a leading net lease real estate investment trust, or REIT, with properties mostly in the entertainment industry. Think ski resorts, fitness centers, theaters, top golf facilities, and many others. Currently, EPR yields 8.08%, and what's even better is that this pays a monthly dividend, unlike most companies that offer quarterly dividends. As of now, EPR Property pays $3.30 per share, which will be helpful in our calculation. To earn $5,000 per month, one would need to invest approximately $742,574 into approximately 17,927 shares of EPR, given its current share price of $41.42. Now that is still a lot, but it's 3 times less than it would be with Pepsi. And if you think you could live off $4,000 a month, then your total investment would need to drop to about $594,000, and a $445,000 investment would get you $3,000 a month. However, it is important to consider whether relying on one stock for a living is a wise decision. Investing in a single company carries the risk of significant financial losses if the company were to falter or cut its dividends, as seen with AT&T in the past. So, diversifying one's investment portfolio is crucial to mitigating risk. One alternative to consider is investing in a covered call ETF, which offers high and growing dividends, increasing distributions, and monthly payments, making them a potentially attractive option for those seeking to live off dividends sooner. While EPR's impressive dividend yield may seem tempting, investing in one stock alone is not advisable. Instead, diversifying one's portfolio and considering alternative options like covered call ETFs can help mitigate risk and provide a more stable source of income. Let's explore an alternative strategy for generating passive income through dividends by considering a covered call ETF. Covered call ETFs offer investors the opportunity to generate consistent income through a combination of dividends and call options. This strategy involves selling call options against an underlying asset that an investor owns, and by doing so, investors earn premiums for selling these options, which can provide additional income to supplement their dividend payments. One such covered call ETF is the Global X NASDAQ 100 Covered Call ETF, which trades under the symbol QYLD. This ETF invests in the stocks of the NASDAQ 100 index and sells call options on those holdings. This ETF also pays you every month. Currently, QYLD offers a dividend yield around 12.76%, which is significantly higher than the average dividend yield of the QQQ. Now, assuming an investor wants to generate $5,000 in monthly income from QYLD, they would need to invest around $470,219 in the ETF based on its current yield. If you think you could live off $3,000 a month, or an extra $3,000 a month would help you retire sooner, you would need to invest just $282,131. Of course, it is important for investors to remember that there are still risks involved with investing in ETFs, including market volatility and potential losses. However, diversifying one's investment portfolio with a covered call ETF such as QYLD can provide a reliable and potentially lucrative source of passive income. I'm an even bigger fan of the JP Morgan Equity Premium Income ETF, which goes by the ticker symbol GPI, which yields a slightly less 11.49% and comes with less volatility, from my experience. And remember, you don't have to invest the entire amount at once. By reinvesting your dividends on a monthly basis, you can leverage the snowball effect and significantly reduce the required investment amount. Now, the extent of the reduction depends on how long you are willing to wait, and if you have a passive income source such as Social Security, a retirement account, or other income streams. I believe that investing in covered call ETFs and other stocks to live off dividends is a more feasible approach than pursuing endeavors like e-commerce or starting a blog. Now, this doesn't mean you shouldn't pursue additional income streams. In fact, I highly recommend it, and it's part of why I created this YouTube channel. I'm all about diversifying your passive income from different revenue streams. This video is about one of the easiest ways to create passive income, but it's not necessarily always the best way, depending on your individual circumstances. Now, even if you can't completely live off of dividends, earning an extra $1,000 or $2,000 each month can significantly improve your financial situation. So, I hope this video demonstrates that living off dividends is achievable, particularly with the help of higher yielding stocks and covered call ETFs. Just watch out for dividend traps. This is when you are enticed into purchasing a company because of a super high dividend yield, but the stock price plummets, causing you to lose a large portion of its principal value. You'll want to invest in companies that have a consistent and established dividend track record. Do also keep in mind that a covered call ETF can be riskier than investing in consumer staple stocks and may also potentially result in higher taxes. So, you will want to understand the tax implications for any investment you make. Regardless of whether you pursue dividend investing for growth or income, the most important part is to simply get started. The earlier you start investing in dividend stocks or ETFs, the closer you'll be to having a reliable nest egg. Thank you so much for watching this video, and if you found it helpful, please click the like button and subscribe. All the best.